Hello and welcome. My name is Risley Sams, founder and president of RHS Financial here in San Francisco, where we help business owners and executives think bigger about their personal finances, and we help them invest with purpose. Well, fall is in the air, kids are going back to school, and it's a good time to talk about education savings. Well, many people know that it's very, very important, obviously, to save for your child's education, but a lot of people didn't know that it is also a good estate planning tool. So instead of hearing me talk on and on about estate planning, which I'm not a professional, I brought in a professional. That's right. So I brought in Beth Kramer. She's from Freeland Cooper and Foreman, and she is an estate planning specialist and is an attorney here in California, and wanted to just talk a little bit about the different type of education savings plans that are out there and how you can use them as an estate planning tool.
Okay, so I most commonly use three different types of ways to make gifts to or for the benefit of children. The most simple way is a California Uniform Transfer to Minors Act account, and that's a great vehicle for like a one-time gift of a small amount, but the problem with those kinds of gifts is that the child gets control of them when they reach age 18, or if you make a special election, age 21. I sometimes also create trusts for the benefit of grandchildren and children, and those are really great vehicles if you have really hard assets that you want to benefit the child with, for example, pieces of real property, limited partnership, things like that. But those are kind of complicated vehicles. What's really great if your main motivation in transferring assets to a minor are 529 plans. There are two kinds of 529 plans. There are prepaid tuition plans and educational savings plans. And what I want to talk about today are the educational savings plans. Those plans, each state sponsors one or more of those plans. And the great feature of those plans is that whatever money you put into it will accumulate earnings income tax free as long as the withdrawals are made for the purpose of higher education. And the person who creates the account continues to have control over the account and over how the account is invested. Now, they have to choose from investment funds that are offered by the sponsor of the plan in whatever state they choose to establish it. However, they get to pick from a great variety of funds. They also get to control, in essence, who uses those funds for the benefit of higher education. So if when the person sets up the fund, they think they're going to benefit one child or grandchild, but it turns out that child gets a scholarship, doesn't go to college, and there are other children or grandchildren, they can move those funds around and benefit the children who most need it. And that's a pretty unusual thing to be able to do in estate planning. The amount that you can put into these plans is in part governed by the state in which you set it up. Each state has a maximum that's somehow tied to the cost of a four-year education in that state. And so in California, the maximum amount I think is about $325,000, but like in Rhode Island, it's about $395,000. Most people like to make their gifts tax-free, estate and gift tax-free. In order to do that, you would be using your annual exclusion, and the annual exclusion right now is $14,000 per person per year. So if you have a father and mother who want to both contribute the maximum amount for one child, that would be $28,000 for a year. But there's a special rule that allows a person to sort of front load the contribution to these plans, so they could contribute $140,000 in 1 year, which in essence uses their annual exclusions for the first 5 years. But then you still have that $140,000 working towards you and earning from day one.
That's pretty amazing. So let me get this straight. They could put $140,000 up front now with that forwarding on the tax exclusion, and then that money gets out of their personal estate.
That's correct.
But yet they still control it for the educational costs for their children?
They do, and if they wanted to take the money back, they actually could. They'd have to pay the income tax on the earnings as well as a 10% penalty. But I've never seen another vehicle where you can remove assets from your estate and still have a way to get them back.
That is actually a pretty amazing estate planning tool. So when we talk about the 529 versus the trust and the utmost, like you said, in the trust you could transfer in real property and whatnot.
That's correct.
Not really the case with 529
No,
plans.
529 plans, you can only gift cash in essence. I mean, the cash gets invested in, securities and the like, but it is not a good vehicle if you want to give non-cash gifts.
But you mentioned, so for example, one of these 529 plans, if one of the children, for example, you had two kids and one kid got a scholarship and didn't need the money or as much of the money, you could, roll over to another child?
Yes, you can use it for another member of the same family, and the members of the family are defined pretty broadly. So even if a grandparent set it up for one grandchild, they could use it for another grandchild, a cousin of the original beneficiary.
Wow, that is pretty flexible. The government doesn't usually allow us to do those kind of things.
That's for sure.
It's very, very interesting. I haven't really thought of the 529 as an estate planning tool. However, when you think about the cost of education and actually the investment in your child's future that it really is, if you put those two together, because the child will, in all likelihood, earn more money over the course of their lifetime with a college education than if they don't have one. And you put on top of that, compounding that with the fact that it is a good estate planning vehicle, they certainly seem to make a lot of sense.
For a lot of people, they do.
Well, thanks a lot for coming in and talking to us today. We really appreciate it, Beth. Again, Beth Kramer. So if you want to get in touch with her, you can obviously email me and I will get you in touch with her. And again, thank you so much for sharing that with us.
Thanks for having me.